Economics.
Chapter: Demand-side and supply-side policies. Examine the strengths and weaknesses of monetary policy and discuss which of these you think are more important. Monetary policy is a demand-side policy used by a country's central bank to influence aggregate demand (AD) and stabilize the economy. It works mainly through changes in the interest rate and the money supply, affecting consumption, investment, and net exports. Strengths of monetary policy. 1. Quick to implement. Central banks can usually change interest rates quickly without going through long political processes, unlike fiscal policy, which may require parliamentary approval. 2. Flexible and adjustable. Interest rates can be adjusted regularly depending on economic conditions. For example, rates can be lowered during a recession to boost spending and raised during inflation to cool down the economy. 3. No crowding out. Unlike expansionary fiscal policy, monetary policy does not involve increased government borrowing, so it doesn't compete with private investment. 4. Independent central banks. In many countries, central banks are independent from the government. This can prevent political interference and lead to more stable and credible policies. Weaknesses of monetary policy. 1. Time lags. Although it's quick to implement, the effects of interest rate changes can take 6 to 18 months to fully impact the economy. People and firms take time to adjust their spending and investment decisions. 2. Ineffective in deep recessions. In a severe downturn, even very low or zero interest rates might not be enough to encourage borrowing. This is known as a liquidity trap. For example, during the 2008 global financial crisis, monetary policy alone was not enough to restore growth. 3. Less effective against supply-side shocks. Monetary policy is not well suited to solve problems like cost-push inflation from rising oil prices or decreased SRAS. 4. Depends on consumer and business confidence. Lower interest rates may not boost AD if consumers and firms are pessimistic about the future. In this case, they may choose to save instead of spend. While monetary policy has clear advantages, especially in being fast and adjustable, its effectiveness heavily depends on the context. For example, during moderate demand-side fluctuations, it can work very well. But in deep recessions or stagflation, its weaknesses become more serious. In my opinion, the limitations are more important, especially the fact that monetary policy is less effective when confidence is low or when there's a supply-side issue. Over-relying on interest rates can lead to problems like excessive inflation or asset bubbles. Therefore, while monetary policy is a valuable tool, it should often be used alongside fiscal and supply-side policies to address a broader range of economic problems.
Thanks for watching. Subscribe to our channel for such educational videos.